Hello, I'm doing the class a little early. It's on a Sunday. I know you guys have been busy, so I figured I just would do this ahead of time and give you the benefit of what I did today. So let's go right to the course shell. And I'm going to close some of these other windows. Okay. And go right here to our course. So this week we're going to do Monte Carlo simulation. And basically, what Monte Carlo simulation is, it's a way for us to use random number generators to make predictions. Just remember, in most things in life, we have random events. Going back to our talk with the capital asset pricing model. What was the capital asset pricing model? That stocks have risks that are indigenous to, I want to share my screen with you. Stocks have risks that are indigenous to um, the stock itself, right? Like, so for instance, an airline might have a risk that oil prices might go up, but that could be balanced out with buying a company like an oil company that drills for oil and gets a break when oil prices go down. And you could do this over and over again. And that's the power of covariance or the power of diversification. So by diversifying stocks, we could take our risk out. Where we cannot take our risk out is in the unsystematic risk, and that's the risk that um, of random events like wars or COVID, things that you cannot predict, right? Wars or COVID. So, like that's something we've been dealing with. Hurricanes, natural events, you can't predict those things. So, how do we build that into a model? We build it in by using a Monte Carlo simulation. Now, one thing I'd like for you to do is this is what I just called up, and the the university gives you a great example by offering you a um, Excel spreadsheet that also does this, right? So it's really terrific. I'm going to call that up for you. Yeah, so the college or the university does a great job by offering you an Excel spreadsheet. Okay, give me a minute. And I thought that spreadsheet was terrific. And let's see. And you could find a guide to how to do Monte Carlo simulation by clicking on that, and it gives you a great guide in Excel. So that's one thing you should make available to yourself. Okay. I'll close that up for a minute. I'm just opening up the different parts of the module where you are definitely going to want to take a look at how to do Monte Carlo simulation. Okay. And I gave you a little something up here on Monte Carlo in Excel. So I would like for you to review that. And that gives you a little tutorial if you didn't have enough on how to do Monte Carlo if you want to do it on your own. Okay. And there's a playlist that will also talk about Monte Carlo simulation. So you got a lot of interesting stuff that the school gives us. But what do nuclear weapons of finance have in common? Perhaps they seem like a preamble to a joke, but both the physics and financial theory utilize a common modeling technique, Monte Carlo simulation. Originally developed by nuclear physicists to model the atomic bomb, this simulation technique is named after Monte Carlo Casino. So really, it's like think of it like a roulette table, where you're constantly getting different numbers that are random and they have no way to predict. The past has no way. We call that a Markov analysis, where Markov analysis basically tells us the past. We have no way of predicting the future by the past. Okay. So the spreadsheet that the school gives is terrific also. So I would download it. I played with it this morning. It's really interesting. And we'll call it up. I want to close some of these things. And so open that up. And the Good Taste Company is forecasting the profitability of the sale of its blueberry exploding delicious gum. As you will note, the model is broken into 3 sections. The description is a brief overview of the purpose of the model. In addition, the probability distribution sales of gum. And this is the model itself. I'll call it up in a minute. So your input would be, and when you put this together, the number of gums that you're making, cost per gum, and how much it costs you to sell to get rid of the gum that you don't use. Because those would be all the costs that they're assuming would happen in this business. And so then you put a probability distribution together, which is 0, 2, add 2 to 3, which is 0.5, and then add 2, 3, and 4, which is 0.9. So that's your probability distribution. That's all the different probabilities that you can come up with in terms of different revenue projections. The rest of the model includes the formulas to drive the model and outputs. Cells C6 to F36 shows an average profit, and cells D37 shows the standard deviation. So not only do you want to see the profit, you also would like to see the standard deviation. Because what does the standard deviation tell us again? If you remember in the past, what did we talk about? It tells us not just the average profit we should generate, but also what our variance from the mean would be. So by using different probabilities and using a variance formula, we don't just find out what our probability is, we also find out the range where we could be wrong. It's like taking a player's statistics over time, right? You take their last 1,000 games, a basketball player, and the points they scored, and then using a random generator of many games to come up with an average of what they would look like over the next, say, 30 games. So you take 1,000 games, and then you pick 30 at random, and you simulate what the player could possibly score in the next game by randomly generating. So you've taken all this history, and we're going to see that with stock prices, and use it to find a random pick of different ones so we don't have any bias, and then we come up with possible points per game. But we also look at how much we could be off by using a standard deviation or a variance from the average or a variance from the mean, which is what we call it, right? And on the spreadsheet, this is Monte Carlo, and this is the probability distribution we just talked about. The demand would be 100,000. Hold on. And the key word this week is soccer. Keyword this week is soccer. So 100,000 demand for the scum would be 20%. 300,000 demand for the scum would be equal to 20% or less than 50. 500,000 would be equal to 50% or less than 90, and 1,000,000 would be over 90%. So you see where this is the bigger average right here. And this is the gum that we're making. This is the cost per gum. This is the price per gum. And this is disposal per unit of gum. And so we do this distribution, and we're going to get this random number generator in terms of what we sold, what our revenue is, and what our costs are. That's what the Monte Carlo simulation does. Okay. So let's go to this one again. So that's what I just showed you. So the model is going to simulate each production quantity of gum, and it's going to assume an initial production quantity of 130,000. And we're going to create a random number in D24 and simulate the demand for gum. So what we're going to do is continue to run this simulation to find the demand for gum. Okay? So we have these outputs, and there is your average. There would be your average. And here are all the potential, revenue projections. So by going to the computer, downloading it, and hitting F9, that's what I'm doing here. Let's see if this comes up. We notice, you should look at these numbers here. This is the mean, this is the potential revenue. And then this would be the revenue based on different projections. Notice that we did it once. Notice the number keeps changing. But at 300,000, we would make 181,000 with a standard deviation of 84,000. 500,000, 216 and 168, and at 1,000,000, 126 and 240. Right? So it looks like our biggest profit, I'm going to keep hitting F9. So what I'm going to do is keep hitting F9, and every time I hit F9, and you should do it, I'm picking numbers that are randomly generated from all my probability distribution, and this thing literally takes 1,000 probabilities, 1,000 projections, and it's looking up those projections, and it keeps, so this would be like every time I hit F9, I'm taking the average on random of 1,000 different possible probabilities. And that's what Monte Carlo does for me. It allows me to continue to randomly, like almost like picking numbers out of a lottery, when the balls come up. And then I can continue to pick them up. I'll find that no two numbers equal each other. But if I put it into a model, I could start to see if one scenario is better than the other. And notice that as I keep doing that, almost consistently, and this is like each time I hit this F9 button, each time you see those numbers change, that's picking over 1,000 different probabilities. Notice 500,000 always produces the maximum amount of probability. Using my model and using Monte Carlo, and then coming up with these random possibilities, I'm finding out that 500,000 is always the best number. Okay? And so that's what Monte Carlo does for me. It doesn't just pick numbers out of a hat, but once I put my numbers in, it gives me a standard deviation and tells me what the best number would be. So every time I press F9 1,000 times, the two-way table comes up. And if you watch my video on Monte Carlo, or you follow what they did, or play with the spreadsheet a little bit, you'll get a better feel for it. So ultimately, we find out that every time it takes a brief pause, it simulates 1,000 demand values, right? It simulates 1,000 demand values and comes up with a new demand. And ultimately, row 36 shows the average simulated profit for each production quantity. By continuing to push F9 a few times, regardless of the number of guns made, a production level of 500,000 will always be the optimum choice. And that's what Monte Carlo does for me. It shows me that I can kind of confirm the fact that 500,000 is always going to be the best number for me. Not 1,000,000 and not 300,000. Because at 1,000,000, I might have to dispose too much gum. The probability of having it is too high. I'm putting too much expense in for something that probably isn't going to happen. But if my probability distribution, and it all starts with my probability distribution. If that's so, if my numbers are going to be off. But if my probability distribution is correct, then what I'm going to find out is that 500,000 is the optimal number. Okay. Hopefully, and now if you have any questions on this, since I know this is a taped discussion, call me, text me, get in touch with me. Not a problem. I look forward to hearing from you. So, and then you can see how the rest of this thing works. So it's pretty clever, and I think it's a great, in terms of modeling, it's one of the things that you really want to learn, right? Because if you're going to do something, and where is it? Let me show you something more practical. How do I predict stocks based on Monte Carlo? Well, this is Microsoft. Now with stocks, I'm going to look at historic returns. I'm going to take historic. Now don't forget, with the gum company, I came up with the probability distribution. With stocks, I'm going to look at different, with stocks, I'm going to look at historical prices. Now, what would the problem be with historical prices? The problem with historical prices is going to be that they're not necessarily, and they say that here, they're not necessarily indicative of what's going to happen in the future. So basically what we do with stocks is we use past performance to predict future performance, but it's not necessarily indicative of the future, right? So, but we have nowhere else to go, and as long as we treat it randomly, we got a better chance of understanding this. So we use a bootstrapping technique. And what bootstrapping really does for us is it simulates future investment returns by assuming the future will act like the past. By assuming the future will act like the past. Many people contend with this assumption. Why will they contend with it? Because they may say that the past doesn't necessarily predict the future, but we're willing to live with that assumption. Okay, so going back to our spreadsheet that the school provides, really good job by the school. They go back on monthly basis. They go back to they go back from 6/1/18, and they will go all the way back to 7/1/13. So they give you monthly returns, and that's what this is. These are monthly returns. Let me open this up a little bit. They give you monthly returns. Okay, and that's how you get it. You get the end month Microsoft price minus the beginning Microsoft price divided by the beginning Microsoft price. You can use log normal, you can use log normal calculations, but in this case, I'm just looking for the monthly return. That's all I need, and that's what it gives me. And then I look at my start price, and from these historical prices, I'm gonna, again, this VLOOKUP is gonna go here, and it's going to find random numbers and give me random scenarios, picking from these 60. Notice every time I hit F9, again, F9 does the trick here. I'm going to get a different simulation. It's going to pick different scenarios. So by picking these different scenarios by random, it's going to give me an end price. It's going to simulate as these are the months it's going to pick. 60 months, but it's going to pick 12 random months, and that's going to be the simulation. So that's going to give me a good idea statistically as to the randomness of what could happen to this stock. And notice every time I hit this F9, I get a different end price. Because when I do that, I'm going to get a different set of probabilities. Okay? Very elegant. And then I'm going to get, once I get that, I can generate whether the probability I'm going to lose money, probability I'm going to make more than 10%, because it's going to give me different end prices and show me the possibility, right? This is my end price. It's going to give me the probability that these events could happen. 79, the probability at 79, probability I'm going to lose money is 27%. Probably I can make more than 10% is 11%. And then you notice in between, we're going to have because these are the mean returns here. In between, we're going to have a higher, anything between 0 and 10 is always going to be higher because these numbers that would randomly generate it mostly came in at 0 and 10. So you're going to notice if you keep in F9, this making between 0 and 10% is going to constantly come up because these numbers in the middle will constantly come up. You're never going to get many months based on historical returns where Microsoft is up more than 10% or down more than 10%. But notice every time I look at my distribution, the numbers kind of bunch up here, unless I get like a real outlier. Now, recently in the markets, we've had a real downdrift. So losing more than 10% might be a little more probable if I just use the last 2 months of numbers, right? Because the last 2 months have been, we saw that in the last 2 weeks, Microsoft and tech stocks have gone down. This goes back far enough where we take that out of the picture. We take that possibility out of the picture. So once again, very good job by the school. We look at the past performance of the stock. We look at the monthly percentage change for each of the next 12 months, and we base that assumption on 1,000 different scenarios. That's more than enough scenarios. So I buy 100 shares. Will I make or lose money? Well, I know that today's stock price is 185, and I get the monthly returns using Yahoo Finance. So they did it already for you, but if you want to do it at home, let me show you. And I also have a video on it. And I'll put that I'll put that video in our I'll put that video in our shell so you know. But here's your Yahoo Finance. So I could find, say, for instance, Tesla. And I can go to historical data. And I can pick monthly like they did. Bear with me. Frequency monthly. And in this case, they went from 1 year. But let's look at Yahoo 5 years of monthly data. I can apply it. And all they did was they downloaded that data. And you could do this, and you should try this at home. So if you want to do want to do a Monte Carlo, you could use this spreadsheet, plug in your own numbers. All you have to do is plug in the numbers where they did. And this would be Tesla. If you notice, these are all monthly data going back to 2016, which is 5 years ago. And then you would just have to work out the returns. Okay, stocks had a hell of a run. Started at 46 and now trading at 388. So you could take those, and since the school already gave it to you, you can plug some of those numbers in here, the adjusted close. Adjusted close. I wonder if we can do this. Let's try it. What the hey? We're going to delete that. We're going to delete that. Let's see if it works. It may not work. I'm not sure. I'm trying this for the first time here. So I need, what do I need? 60 observations. Let's give it a shot. I don't know if it'll work exactly, but let's try it. At least it gives you an idea how to do it. So we'll get 1 to 60. 60. Copy that. No, it's not the wrong one, I'm sorry. We'll go here. Once again, the keyword is soccer. We're going to do 1 to 60. We're going to take 60, and that's going to be our historical return, right? Put that in. I don't know if this will work, but we're going to give it a shot. Okay. I'm going to just copy that one into here, just to see if it works. Then we'll erase these. I'm not sure if there was something I needed to put on, but let's give it a shot. So we'll hit F9. No, I'm sorry. That's not going to work. But I'd have to play with it a little bit, and maybe I will, and then put this on for a later date. But at least now you know how to download the numbers, and you can download a lot of data. And actually, there's some more sophisticated modeling software like R that will allow you. They actually encourage you through their own commands to just download Yahoo Answers. You could do it in Stata. You could do it in R. You could do it in Excel. A lot of the more sophisticated programs will work with you on that, and they'll tell you to use Yahoo. That's how you use it. So we're going to plug that in. We're going to calculate the monthly returns. And how do we get the range of Microsoft stock? The bootstrapping method tells us that the return on Microsoft in any month is equally likely to be any of the values that we put in, and it'll randomly pick. And by random, it means the function will generate a random number between 1 and 60, corresponding to the 1 and 60 months that we put in. And we'll do a VLOOKUP, so we pick out the ones we want. And the end price is the start price plus the return of growth by looking at those returns that we picked. And we'll generate those numbers and copy the end price. So you could do this. Use the count if to summarize the results, and then you'll get your return. You'll get a mean return, and you'll get those probabilities whether you can make or lose money. So let's go back for a minute, since I did not like, I tried to give you an example test. So like I said, I'll give it a shot at a day, but let's go back to our numbers. We'll call that spreadsheet up again, and we'll do it with the Microsoft numbers. Keyword, once again, is soccer. All right, so there it is. We'll call up the Microsoft. And all we have to do is keep hitting F9, and the computer will do the rest for us. And actually, we showed you how to do it. So you can create your own. It's painstaking. I won't say it's the easiest thing to do. If it was, everybody would do them, but you have the model here. And to be quite frank, and there's your probabilities again. Again, notice that the probability is always going to be higher in the middle, 0 to 10%, because that's where most of the return is going to come from. F9 again. And there you go. You keep pulling from those 60. Again, historic returns aren't necessarily indicative of future returns. And but the Monte Carlo simulator is very interesting. So what's the difference between the bubble gum and the stocks? The bubble gum, we provided the probabilities. With the stocks, we use historical values to get the probabilities. That's the main difference. Going back to the shell, let's look at that. So you've got simulation techniques. You've got a couple of very interesting articles on how to use the Monte Carlo approach. You have the ebook chapters you should be following. And ultimately, you have the, well, we gave you your objectives, but you can actually watch my video. And there's another example of how to use Monte Carlo. Now, this is what I want to say. If you have access to a Bloomberg, the Bloomberg machine, and this is a nice little video on how to use Monte Carlo. A little more simple, but if you just, she does a good job. So if you want to spend a little time with that, go right ahead. You know, that's why I provided it. one of the things I wanted to point out to you, so we're going to have a discussion this week. You've learned a lot about modeling so far. Great job. You probably have noticed many things you can go wonky while creating a model. Many of these problems stem from pitfalls with financial models. We are not trying to be negative, but by focusing on what you can go wrong, you'll be aware of the potential problems. The most common pitfall is user error. Creating a model where your numbers are off. For your initial approach, share some of the pitfalls you've encountered so far. Why do you think you got them? Why? What are some of the actions you can take to sidestep those pitfalls? Now, one of the main pitfalls that I think you'll get is going to be bad information, bad data. And an example of bad data, 2008. Why was that data bad? Well, I want you to watch this video. It's an excellent video. And it shows you how bad numbers created the crisis. That companies that use things like value at risk, which we talked about earlier, got involved with some very bad prices. They assumed that housing prices would always go up, and it did. And this is one of the best things on the internet. These people really do a great job explaining how this came down. And because they always assume that housing prices go up,
the crisis of credit.
And so because they always assume that prices went up, they built their model based on prices always going up. And when those prices did not go up, then they had this horrible, this really bad data in their models, and companies like Bear Stearns and this video to learn how bad so by doing that, they created a model that was off. And by relying on that model, they really cost themselves a lot of money because they relied on that model to take on inordinate risks, assuming, well, that downside housing securities would not as much as they actually would be. So watch that video and let's talk about that. Please try to comment on that because I think it's a real good example of one of the ways you can have bad data. And here's what I'm going to say. Please comment assumption of housing prices constantly increasing created take a look at that and tell me what you think. But I think you'll find that it'll be real interesting and it'll be a real eye opener. Now, keep in mind that when Wall Street used these assumptions, they looked at about 100 years of data. And yes, 100 years before '08, housing prices did go up a lot. What they didn't realize was that in the past, even going back to Roman days, Julius Caesar was the emperor, there was a housing crisis. What happened was Europe, the wealthy, which was a small group that controlled the Roman Empire, when the army came back, they wanted to keep these people happy. And so the Caesar suggested you have all of these lands, give small pieces of land to these gladiators, to these not gladiators, these generals. If you watch Gladiator, actually, you start to see these generals who come back, and let them lend the money from you, and this way they can build their own wealth up, and they'll be happy, and we keep peace because we need the army. Well, like anything else, the Romans conquered as much as they could, and there wasn't as much left to conquer, which is the story of business. At first, it's a great idea. When things are successful, you make a lot of money. But at one point, many cases, the businesses died down. Look at Sears. Look at General Motors went out of business. And now these Roman generals could not pay back these senators and these wealthy landowners. So what winded up happening is they had a housing crisis. Property values couldn't pay their mortgages. This is what happened in 08. The difference was Caesar was an emperor, so he cut the mortgages. And he was able to do that because basically he was an emperor. We have it a little bit different over here. We don't have emperors, thank God. We have presidents and we elect people. So that doesn't happen here. But it's a great example. It's a great example of how one of the pitfalls you'll experience. So that's really good in week 5. And I hope that you find that interesting. So once again, I want you to watch the videos. I want you to go over the model. What I would suggest is call up this model and hit that F9 button and keep doing it until you see how the random generator works and how it generates probabilities. And if you have the time, and I'm going to try it myself at one point, see if you can put your own numbers in there by downloading some stuff from Yahoo Finance. And that's not that hard either. You go back to Yahoo Finance, go to historical data, change the numbers around, and you should be able to get that done. Okay. Once again, how do you find that? Let's do it one more time. You just have to go to Yahoo Finance, and it's such a great tool. One thing, I know people think of Yahoo as like second rate, and I know Google and those places have done much better. I get that. But Yahoo has done a tremendous job on their finance module. So let's pick another stock. Let's pick. The nice part is you just have to put, even if you just put the word in, you don't know this. I know the symbols from trading on Wall Street, but there's Apple, 108 last. And just if you notice what's happened recently, and you should be following the markets, as I always tell you. You should be following the markets. The 5-year trend has been great, but we've had a real downdrift. The stock was as high as 129, it's dipped down to 108, which is a big move recently. It's 20 points. So we go to historical data. And once again, how do you adjust? Well, you have to find frequency. We're going to say monthly to kind of coincide with our spreadsheet. We're going to look at the last 5 years. You can do max, but let's look at the. We're going to have to hit apply. And now you have monthly data. And then all you have to do is download it. One thing to remember when you download the data, it comes out as a CSV file, which is some sort of, I'm not sure what CSV means, but you want to save it as an Excel file. It's more user friendly. Why they don't download it, maybe it could be a licensing thing. I'm not sure. But what it'll give you is everything you just saw, the date, the open, the high, the low, the close. I would get rid of these. And you just need the adjusted close, which accounts for dividends. So just delete those. We're not going to use the volume now. Delete that. And really, to find return, all I need to do is say this minus the previous close. Put some brackets around it. Divided by the previous close. And again, Bloomberg will do a lot of this for you, but it's nice to know. What's nice about, and it was minus 10% for that month. What's nice when you're in a modeling class is that you learn how these things actually work. It's like it's nice to drive a car and get in it and know how the car works. That's obviously a nice thing. That's not good. Okay, there we go. But what's even nicer learn why the car works the way it does. Now, you may never want to go back there and rebuild the engine again, but at least now you know as you're driving the car, as a race car driver, say, why the car works the way it does. I turned it into percentages, and there's your percentage gains and losses. Now all I had to do was create a random generator, and I would pick, say, 60 of these observations, and that would start to tell me if I pick them, then I have a random sampling of returns. So there you go. If I did the VLOOKUP, and I'm not going to do it now, and I pick 10 of these randomly, I have a random sample of monthly returns. Me personally, to be comfortable, I would do weekly returns because I think monthly. Although the nice part about monthly returns is you take out some of the noise that happens every day. You could do that with weekly. Again, in the real world in Wall Street, you would play around with enough models to see which one you really like and which one made the most sense and which one back tested the best. So going back and looking at how it back tested, this would be a great opportunity. Okay. All right, we're going to stop here. Again, we did this. I did this on a Sunday. I assume you guys aren't going to be around tomorrow morning, but you can call me if you watch it and there's questions. We could set up a call. There's only two of you, and I'm more than willing to do that. All right, and I'll send you an email to that effect. So have a great evening, and it's great talking to you, and it's a pleasure working with you. I really am having a great time with this class, and I got to tell you, Rasmussen does a great job. They really do. All right, have a good night.